Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome. You're with us on Bazaar Morning Call, and as always we're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay, with me as always Nigel D'Souza, and today we have Rima in the house to decide whether the bulls can march ahead. They touched that all-time high yesterday, couldn't quite stay there. Maybe Rima is going to be the lucky charm today.
Well, I'm all dressed in green. I hope I'm the lucky charm. But today's the last day of November, so December is finally going to, kick-start. Nigel's been counting down to that. Salary comes, Nigel, and Black Friday.
Well, that's
Don't
right.
you think Black Friday's got a bit of a scary tone when it's such a happy, festive? It's like the start of the shopping season.
I always
but,
wondered.
Black Friday.
It's astounding, huh? Actually, we'll see what those retail numbers look like. A lot of the listed stocks, because there's so much excitement. Growing up, I never knew anything about Black Friday.
Never.
And now all around us, it's only Black Friday.
You open the papers and it's about the Black Friday sale.
Well, that's right. Keeping an eye on my wife, what she's going to be buying, because, online, I believe at 12 midnight or something, there were some sales that started. That's what my antennas tell me. But otherwise, as Rima said, it's a very, very good day. Why is that? It's a Friday, it's salary day, and it's beginning to look a lot like Christmas. 25 days.
And the smog in Mumbai has reduced a little bit.
Yes.
So yes, absolutely. Thankful for that. Anyway, let's get started. Lots of cues to track this Friday morning. And yes, because it's Black Friday and because we had the Thanksgiving holiday in the US yesterday, so we don't have too many major global cues. I want to start with what happened here yesterday and why this has been a bit of a rally of disbelief. I mean, an all-time high, which is mired in disbelief because it's been very, very narrow. It has been very large cap-centric and large cap-led. So what happened yesterday? The Nifty did touch that mark of 26,310, but couldn't quite stay there. There was profit booking that came in, which is fine. A little bit of fear of heights is what you always expect, which is why today and more importantly next week become very, very crucial, because if the indices can take out the current levels decisively, if the Nifty can really march past 26,300, then what is a rally of disbelief might start turning into a rally of participation and belief. Let's look at the numbers. The Nifty and the sensex are at all-time highs, but look at the lack of participation just in terms of sectors. Real estate index is 20% off the peak. IT, obviously, we know hasn't performed, so it's 18% off the peak. Defense is 13% off the peak. The small cap index itself, whether you're looking at the small cap 100 or the 250, is 9% off the peak. The FMCG, index is 50% off, and even the Nifty Next 50 itself is 5% off the peak. So there's a lot of scope for participation and for real momentum to start kicking in. But we need a more decisive close for the Nifty above that. Now coming to the global cues, which are a little thin, like I mentioned, because of the Thanksgiving holiday. And even tonight, US markets will be shutting early. They're I think, done by 1 p.m. Eastern time. The Dow and the Nasdaq, if you're looking at the futures, not much, very, very flat, little change, 0.1% the last time I checked on the Dow, the S&P and the Nasdaq. By the way, the US market is all set to end November with a decline. And in particular, the Nasdaq is interesting because it could be ending its 7-month winning streak with this whole AI boom. So that remains the biggest question mark as we wind down November. Is the AI trade still intact? Will it be a buy on dip? Or whether people are looking to now diversify away from AI and tech? There's interesting, news on Russia and Ukraine, because of which oil markets are fairly range-bound. Brent is still around 63 to the handle, but the oil markets are watching this development very carefully. In fact, before I carry on, let's hear out, because this is the first official statement that we have from Mr. Putin on this peace deal, peace framework, which is being stitched together by the US. He says, and I quote, that in general, we agree that the draft US agreement can be the basis of future agreements. Let's just hear out Mr. Putin, and then we'll recap the rest of the cues.
We discussed it with US negotiators before my visit to Alaska. Afterwards, the 28-point list was formed. As I've already said publicly, it was given to us through certain channels. We studied this document. Following that, the US-Ukraine negotiations took place in Geneva. As I understand, they decided that all 28 points should be grouped into 4 separate components. We received all this. In general, We agree that it can be used as a basis for future agreements, but it will be impolite on my part to speak about any final versions, because there are none.
First acknowledgement from the Russian side about this whole effort that is underway, helmed by the US, to get a peace deal in place. So this is a very important cue to watch. And the other, obviously, is as we enter December, expectations of the Fed cut, which, by the way, have pulled down the dollar quite a bit. Anyway, the trade was very thin yesterday, but the dollar index is down about 0.5% for the week gone by. So watch the dollar. The expectation is that, we'll, in all probability, get that 25 basis points rate cut in the US in December. Finally, ending with what the Nifty has done this month. So global markets have taken a bit of a backseat. US markets, like I said, are going to be ending the month on a down note, but we have not been bad at all, particularly on the large cap side of the screen. Nifty's up 2%, mid cap index is up 2%. Small cap index is actually down 2.5%, which is the point. If the rally of disbelief turns into a participation filled with belief, broader market participation, then it could be a real merry December, Nigel.
Well, that's right, Surbhi, and, at the start of the November series, I recall making this point that, we haven't partied with the global markets, but maybe towards the end of the year, Santa comes to the Indian markets. And that seems to be the place because at least in November, the Indian markets have outperformed. But let's take stock of the data points that we got yesterday. In terms of flows, the DIs continue to be buyers, the FIs were sellers. Though keep in mind, yesterday you had a couple of large trades as well. Moving to what the FIs did in the index future as well. Yesterday, there was some mild covering of shorts. There was some long addition as well. And the short positioning is at around 81%. So yes, FIs are net short, but not aggressively net short because the short contracts in absolute terms are not more than a lakh contracts. We have also seen 1.8, 1.7 lakh contracts on the short side. But the more point is that, in fact, the FIs are still net short. And in yesterday's trade, it appears there was some covering on the Nifty because, the open interest was lower. The Nifty ended more or less flattish, mildly higher. But what's going to drive the way really from here on is the Nifty Bank. That's been moving with good momentum. There's a lot of buying out there, a lot of interest with regard to fundamentals as well as technicals. And there was some fresh long addition that we saw on the Nifty Bank in yesterday's trade. The India VIX, cooled off yesterday, even when we were lower in trade, which is encouraging. And the PCR, that was running away to around 1.5, that's cooled off a little bit to around 1.16. Remember, when it goes to around 1.6, 1.65, that's when, in fact, you see some cooling off in the market. Now, it's cooled off from around 1.5 to around 1.16. And also, we're going through a bit of consolidation, which the bulls will like. A couple of strikes that were active, though, 26,300 call. Very, very aggressive writing is what we're seeing out there. The bears are shifting the goalpost higher now. They believe that the 26,400, 26,500, they'll want to defend that level. On the downside, though, you're seeing the 26,250 put. Fair bit of open interest out there, premium at around 111 rupees. So if you want to punch in the levels, going by the technicals, going by the options data, well, yesterday's high, first you'll want to make a higher high. So that's important. That's the first level of resistance. While the options data suggests that this 26,000 to around 26,100, that's the important mark that you want to track. The Nifty Bank, beautiful looking move is what we're seeing out there. Well, yesterday's low, well, that's important. And you have the 20 DME as well. So this is the broad range you don't want to, break on the downside. But the Nifty Bank as well as Reliance Industries, they seem to be in fine mood. And that's what could drive us higher from here. Two stocks I'm looking at in terms of stocks in news. One is, PNG RBA. They have finally, reviewed that, the tariff increase. But it's not as much as expected. So that's why a couple of downgrades on GAIL itself. So GAIL is a stock that we'll be tracking today. Could be under some pressure. And the other one that I'll be looking at is IEX because, there'll be a hearing today with regard to Aptel will be hearing the case. So that's the other one that we'll be looking at in today's trading session. Could expect a wild move if something comes out of that.
Interesting. Thank you for bringing that to our notice. But after hitting all-time highs yesterday, the question is what next and where do we go from here? So here is an equity call to begin your day with. Venugopal Garre of Bernstein says that the market performance trends point to the down cycle phase ending. Crude is showing no signs of a prolonged spike. The macro is expected to enter a recovery phase. And he says, given these pointers, along with the fact that the worst scenarios for rupee has played out, and emerging positives on a possible US deal, equity markets are likely to stay buoyant in the near term, with our year-end Nifty target of 26,500 likely getting achieved. Well, there's one more important statement that came out of Donald Trump. He said that the US may completely eliminate income tax fueled by surging tariff revenues now hitting tens of billions on a monthly basis. Listen in to that.
As an example, Japan, 650 billion. South Korea, $350 billion. European Union, $950 billion. And they are building plants now in the United States because they don't want to pay tariffs. So this is one of the biggest things economically that's never happened. Nobody's ever seen anything like it. And over the next couple of years, I think we'll substantially be cutting, and maybe cutting out completely, but we'll be cutting income tax. Could be almost completely cutting it because the money we're taking in is going to be so large.
Okay, so tariff revenue is rising, but the question is it at a scale that can eventually completely eliminate income taxes in the U.S.? That remains to be seen. But for now, let's invite Vikas Prashad, Portfolio Manager, Asian Equities at M&G Investments, on the show now. Vikas, thank you very much for joining in. Looks like there's one step forward towards a peace deal between Ukraine and Russia. Would you read too much into it, or we've had too many of these blow hot, blow cold kind of narratives?
Rima, good morning. It's always nice to be back. Blow hot, blow cold, perhaps, but it seems like we have made progress. We're nearing the 4-year mark now in this conflict. I think the market, if you look at it, the market is starting to price in some sort of a resolution here, whether it's the oil markets or equity markets, which continue to be quite resilient. I know we've seen some turbulence in tech-related names over the past few weeks, but broadly, markets are much higher, and they have been much more resilient this year than one might have expected had somebody told us on January 1 everything that was going to happen.
Vikas, hi. So the biggest question, I think, of the month has been whether the AI trade is still intact, or is it winding down? So is it time to look elsewhere and diversify the portfolio? And that has a huge bearing on us sitting here in India, right? What's your sense?
Well, if we start in India, and then I'll go more broadly, we don't have the Mag 7, but after nearly 1,000 listed new listings in the past 4 years, 1,000 IPOs, we have nearly 7,000 listed companies in India to choose from, which is heaven for an active manager. So while we might not have the Mag 7, we have the Mag 7,000 available in India. We might not have the AI trade yet. We're starting to see some aspects of that manifest themselves in some of the companies that we have. But every other sector that you can imagine is there. It's a very broad and deep market. The setup heading into 2026 is quite positive. You said some of the things that I can now build on in the previous segment, that banks, some of the laggards that we've seen, small caps are positioned well heading into the new year. I just came back from a week in India. There's nothing that changed my mind about the long-term growth trajectory. What do you want? You want long-term economic growth. You want political stability. The election results from earlier this month highlighted both of those things. And as an active manager, you have a lot of choices. The ECM activity, capital markets, continues to be buoyant. Now, more broadly, when it comes to the AI trade or the tech trade, we spend very little time thinking about whether there's a bubble or not. In markets, there's always a bubble somewhere. But what we look at is a very long-term growth opportunity in hardware and in software around the world.
Hi, Vikas. Morning, and good to see you, Ben, as always. Well, you've been largely constructive on China. I recall in our last few interactions. What about the toss-up between India as well as China? Because year to date, China continues to outperform. I think ballpark, they're up 15 to around 17%, while Indian markets are up close to around 10% or thereabouts in local currency terms. However, in the last 1 month or so, China and India, that trade has become encouraging because from an India perspective, because India is up 2%, China is down close to around 2%. Do you think India can get back to its outperforming ways? Or do you believe there's still enough of juice, in China with regard to valuations, with regard to the money that is, sitting at the sidelines and the stimulus that's likely to come about?
Well, Nigel, the benefit we have as a pan-Asia investor is that we can make different strategic bets across different strategies. Yeah. In our Asia ex-Japan strategies in recent days or recent weeks, we have indeed reduced the underweight that we had in India. In the India strategies, we have been fully deployed throughout this year, just like last year, heading into next year. That is the same. I continue to believe on a long-term view, and long-term meaning more than a decade. Just as we've seen over the past 2 decades, India remains perhaps the best long-term equity compounding story in the world. As a pan-Asian investor, however, we still like Chinese equities. We didn't mention South Korea. That market has been wonderful for equity investors this year. Japan also. We're very constructive on all these markets. We make our bets bottom up. Yes, of course, we pay attention to top-down exposures by countries and by sectors as well, but we see opportunities all across Asia. The broader point here is the divergence we have seen between the US and the rest of the world, or the US and Asia, broadly, if you take out India over the past 2 decades, we think that that will continue to converge. And this year we saw that at the beginning of the year. Then the AI trade was helped keep the US markets quite buoyant. But over the next few years, there's a lot of opportunities all across Asia, perhaps in India most of all.
Okay, all right. Just a quick question, since we spoke about AI and tech as well. I think you had an underweight stance on Indian tech. That seems to be getting some interest finally. It's been a rank underperformer year to date, last 1 year, last 18 months as well. But what's the view right now? You continue to hold the underweight stance?
Largely the same. We have lessened that underweight somewhat, partly because of the underperformance, and also because the earnings results from the companies that we had positions in, they were constructive, they were favorable. So we have, rather than add new names in the sector, we have added to existing holdings at the margin to lessen that underweight. But when you look out 1 to 2 years, the earnings headwinds remain. Now the question is, what multiple do you want to pay on that? If you look over the last 10 to 15 years, going back to the GFC, the forward earnings multiples for Indian IT services companies are still above where they troughed in previous down cycles. So even though they have underperformed, our focus is on prospective earnings. Also, what I should add is, as a long only, as a team that is always fully deployed, if we want to buy something new, we need to sell something. And relative to reducing the underweight materially in IT services, we don't see reasons for that yet, to take away from existing holdings that we prefer even more.
Okay, Vikas, great chatting with you. Thank you very much for joining in. Moving on now, let's tell our viewers the interactions that we've lined up on the show today. So first up, coming up at 8:35, the management of J&K Bank will join in to discuss the bank's fundraise and the outlook. 9 a.m., Bernstein's Pranav Gundapillai will join in for a banking sector outlook. 9:20, Sailesh Rajbhan of Nippon India Mutual Fund will be our market master for the day. 9:35, the management of Happiest Minds will join in to discuss their H2 outlook. And following that, the management of IGI India will be chatting with us at 9:45. Well, we've got an action-packed show coming up on the show.
Well, that's right. Time to slip into a quick break. We've got a lot of stock-specific action track for you. Get to that in just a bit in our special Top 10 segment. But I'll run you through the list. Wipro, Lodha, Voltam Transformers, Reflex Industries, Bandhan Bank, they'll all be reacting to positive news flow. Add to the list Zydus Life as well as Car Trade Tech. On the flip side, GAIL, MQ Pharma and MTAR Tech will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. We told you about the macro setup. It's time now to tell you about the stocks which should be on your radar this Friday morning. Our research team is joining in. Sonal, the big one is going to be GAIL, where the increase in the tariff seems to be less than what the management was aiming for.
Well, finally the tariff order has come by and it has been months of wait. The PNGRB, they have gone ahead and approved a tariff hike of around 12%. This was versus what GAIL had asked, 33% revision, and also lower than what the street was estimating of around 20%. So this has come in as a disappointment. To give you the numbers, the tariffs are now at 65.69 rupees per MMBTU versus earlier levels of 58.6 rupees per MMBTU. Now, there are a couple of adjustments to this because PNGRB has not considered future OPEX or CAPEX considerations in their working for this tariff. They say they do not want to increase tariff at one go, but want to smoothen the process, and that's why there will be another revision that will take place for tariffs in FY28. And that is something which ICICI Securities thinks will be a window for further revision, which will be an upside risk for GAIL. So yes, the current tariff is lower than what the street was estimating, but there is the possibility of further upside from current levels, and that is what brokerages are positive on. But going with red today, because street had largely factored in at least a 20% tariff hike, so that stock will be on our radar.
Okay, all right. Sonal, thanks a lot for that. Well, let's hop across to Vinny. She's here to tell us about some stocks that are on the news.
Hi, good morning, Nigel. So first up, we'll start with Wipro. We're expecting green here after the company has entered into a multi-year agreement with Odido Netherlands BV. This is to transform IT landscape as well as enhance the customer experience across the board. So that is why we'll see some bit of a positive move, mild positive here for Wipro. Lodha developers could expect green here as well. The company has received a 521 crore refund from the Supreme Court, and the order actually mentioning that Lodha developers' position on a bona fide successful resolution application application, and this was in relation to the V Hotel, where they have legitimate interest in the property. So concerns around that also goes off, and they'll get that refund which they put in at 521 crores. Voltam Transformers, that also green is what we could see here. The company has won an order of around 85 crores. This is a domestic order from Gujarat Energy Transmission Corporation, mainly for designing, manufacturing, testing and supplying of power transformers. Lastly, Reflex Industries, that's also something that we'll keep an eye out on. 100 crore order is what the company has gotten for excavation, loading and transportation of pond ash as well as bottom ash. The time period of this project is 4 months, so we'll keep an eye out on that as well. Green expected here.
Okay, all right, got it, Vinny. Thank you very much for all of those stocks. But we're not done because Hormaz has a couple up his sleeve as well. Hormaz, which names are you looking out for today?
Morning, Survi. Definitely more than a couple for sure. Bandhan Bank, start off with that. The lender has decided that they are going to sell a part of their NPAs and written off loans portfolio through a bidding process that will be involving some asset reconstruction companies. The NPA portfolio is worth over 3,200 crore rupees and the written off portfolio is worth around 3,700 crore rupees. So loans worth close to 7,000 crores will be on sale for Bandhan Bank. So expecting some positive move here. Another positive news for Zydus Life because they have received a tentative approval from the US FDA for a tablet that is used to treat the type 2 diabetes, and the tablet for which they have received the approval, which is the empagliflozin and the linagliptin tablets, they have a market size of around $215 million. Some negative news flow for Emcure Pharma. They have mentioned that there were search operations conducted by the GST Mumbai authorities between the 24th to the 26th of this month. So some negative reaction there. Cartrade Tech, the stock was down yesterday because of a negative news development with regards to a potential acquisition, but Goldman Sachs used this opportunity to sell some shares through multiple funds, and those shares were bought by the Small Cap World Fund. So you can expect some positive moves here because a big fund has been a buyer here. And MTAR Tech is a negative development here, but despite funds like Motilal Oswal and Bajaj Finserv being buyers, the promoter entity having sold stake might just turn out to be a bit of an overhang on the stock.
Okay, all right, got it. Thank you very much for that, Hormaz. Let's quickly recap our list of stocks to watch this Friday morning. The ones that have positive news flow are Wipro, Lodha Developers, Voltam Transformers, Reflex Industries, Bandhan Bank, Zydus Life and Cartrade. While stocks with negative news flow would be GAIL, Emcure Pharma and MTAR Tech. Okay, GAIL, we need to watch. Some of the brokers are not that negative with this 10% hike. We'll see how it goes, and more on GAIL coming up in just a bit. But for the time being, let's go across to Manisha Gupta for a roundup of all the commodity action. Overnight, not too many queues because of the Thanksgiving holiday. Manisha, what are you tracking?
Oh, yes. The volumes have been quite lackluster there. But, the markets still are waiting for the U.S. Fed meeting with 85% probability of a rate cut coming in there. We're looking at a lot of action in sense of prices here. So when you look at gold, it has been on the stronger side. This is the fourth straight month that we're looking at gains come in here, the best yearly gain since 1979 as well. The silver prices, in the meanwhile, overnight have gained up more than a percentage point. We are $0.50 away from its all-time highs, with markets believing that perhaps the absence of U.S. market could lead to exaggerated moves coming in for this space. So $0.50 away from all-time highs when it comes to silver. The only thing that I see is declining is the crude oil prices, headed for a fourth monthly loss. This is ahead of the OPEC Plus meeting on Sunday, and also Russia's president's statement saying that U.S. peace proposals with Ukraine could lead to future agreements. That has led to some bearish tone in energy space.
Thanks a lot for that, Manisha. Well, let's hop across to Sudarshan, as always, joining in to give us all the brokerage calls of the day. So, good morning.
Good morning, Nigel. So I'll start with Jefferies has written on real estate companies, believes that new launches have improved after the festival period, and now listed companies or its coverage company are likely to post pre-sales growth of 25% FY26. And amongst preferred picks, Godrej Properties and Lodha, which these two companies are expected to have a strong growth, especially in H2 FY26. And remember, the realty index is down almost 20% from the 2024 peak. Now coming to the next one, Jefferies has written on Lens. It has initiated coverage with a buy call and target here is 500 per share. It says it's India's largest tech-driven eyewear retailer with market share of just 5%, and it offers strong growth potential. Its vertically integrated omni-channel model ensures cost efficiency, rapid delivery and superior customer experience. India serves as a bedrock with more than 85% contribution to EBITDA, and as per Jefferies, Attractive unit economics and fast paybacks should drive 50% adjusted EBITDA CAGR over FY 25-28. Nomura has initiated coverage on Anthem Bio with a buy call, and target here is 740. It says company is well positioned to capitalize on CRDMO opportunity and expects sales growth of in the range of 14 to 20% and earnings growth of 26 to 27% over FY 26-28. While the growth might be muted in the near term, but it might accelerate from FY 27, and also steady growth of key molecules and new launches are the key catalysts as per Nomura.
Okay, all right. Thanks, Sud, for that. We are going to keep a lot of these stocks on the radar. Need to take a break, but then we come back with the big story of the day. There is a hike in tariffs for GAIL, pipeline tariffs, but it's not as much as what the company had been asking for. So what does this mean for GAIL, for the overall, tariff sort of feasibility in the country? We'll connect with Mr. A.K. Tiwari, member PNGRB, on the other side.
Welcome back. As promised, let's focus on the big story. PNGRB, well, they have gone ahead and approved a revision order for GAIL's transmission tariff, but the street will be disappointed because it's lower than what is expected and it's lower than what GAIL had asked for as well. What are the factors they considered? What are the factors they didn't consider? We have with us Mr. A.K. Tiwari, the member of PNGRB. Good morning, Mr. Tiwari. Thanks a lot for joining in, sir. Tell us, what are the factors you consider and didn't consider? Street was anticipating a much higher tariff. You have come in much lower. Tell us more.
Yeah, very good morning. First of all, thank you very much for inviting me on this channel.
Thank you, sir, for coming in.
And I would like to say a couple of things on this, that the entire board, after detailed deliberations, has concluded this tariff, interim tariff of GAIL, in the interest of the consumer as well as in the interest of the GAIL. I would say how. The primary reason, normally the tariff is to be revised within a period of 5 years. So, in fact, the tariff could have been due there after 5 years. That means last revision was there in the year from 1st April 2023.
Okay.
And normally it could have been done in the year 2028.
Okay.
Now there are the two reasons for tariff revision. One is the capacity determination, which has been done by Engineers India Limited, and second is the deallocation of gas, of APM gas by the ministry. So these are the two basic reasons, and wherein we have determined the tariff of 65.69, considering all the three factors. Actual SUG we have given, future SUG we have partially given, and the capacity determination hike we have totally given. So this interim relief is in the interest of GAIL. How it is so? Normally, if we could have revised the tariff, then the next review could have been done in the year 2031. Now, if you see the order, we are going to revise the tariff of GAIL from 1st April 2028. So this is the only interim relief, and wherein we have given 7 rupees hike, and will prove all the factors of SUG, actual OPEX,
Mr. Tiwari,
everything will prove up in from which will be effective from 1st April 2028. So one factor I would like to say, if market expectation could have been 2 or 3 rupees more, now we are going to then the tariff could have been concluded in the year 2031. So we have given interim relief, and partly this will affect the unified tariff also. We are going to conclude the two-zone tariff in the interest of the PNG.
Mr. Tiwari, sir, I think what people are trying to understand, what the street and GAIL's shareholders will also want to understand is that GAIL had asked for a 20% hike. You, as you mentioned, you've taken some parameters. You've taken this SUG, the system usage gas, and one more parameter. But I believe you've not considered the actual total capex and opex that GAIL will have to undertake. Why is that, and why are you breaking it down? Why are you staggering it out? You're saying you've given 12% relief now, the remaining will come in FY28. Why stagger it?
This is primarily basic reason is that we have concluded the tariff interim in between the 5 years also. So next hike will be from 1st April 2028. So where we'll do up everything.
So you're saying that now, instead of in the previous sort of system was that pipeline tariffs were being revised every 5 years, you're saying that now you'll be doing it a little more frequently, but in parts. Is that the right way to look at it?
This tariff, this revision we have done partly as an interim relief, but normally it has to be done in the year 2000 after 5 years.
Correct.
So that is the reason.
But but there will be another round of relief in 28 that you've already stated.
Yes, it is clearly mentioned in the tariff order that next revision will be effective from 1st April 2028, wherein we'll all true up all the factors, capex, opex,
you will take all of them into account. Sir, just to understand, what was the thinking? Because when GAIL applied for the tariff revision, GAIL was seeking, tariff somewhere around, I think, 78 rupees per unit, right? So, was the board in agreement with their arithmetic, largely? Maybe you've not assumed all the parameters right now, like you explained. But did GAIL's arithmetic seeking a tariff of 78 rupees per unit, did that make sense to the board?
Yeah, but 78 rupees was too much. Our calculation was in around 70 rupees, 69 rupees, like that. So 2 or 3 rupees reduction is there. But the positive part is that we are going to revise again after 2.5 years.
Okay.
So that will give total relief to GAIL.
Okay. All right. Mr. Tiwari, just to clear a couple of aspects, you're clearly saying 2028 is when the revision is there. But from an investor perspective, they were hoping for a much higher increase. You're saying you gave 12%. GAIL asked for 33%. Street was in that vicinity, I think, of around 15 to around 20%. So a couple of clarifications. Is there some hope now GAIL can, can ask you all, can request you all to have a relook at this? Or this is done and dusted? You're not going to have a relook in 2026 or 2027. The next date comes up only in 2028. Is that correct? Or is there still hope in the next 2 years that something can happen?
See, two things I would like to clarify. This is the interim relief.
Yes.
And we are not going to review anything again. Okay. Second is that from 1st April 2028, we'll review and give all the parameters which are due to GAIL.
Okay, all right. Just one more thing, sir. There's a zonal tariff change as well that's expected, right?
Yeah.
Could you tell us when do we see that and a rough quantum that you could look at?
After this GAIL's tariff, one more tariff of pipeline infrastructure is due, which is going to be concluded very soon. And we are going to this zonal tariff of CNG, PNG for 1 zone and 2 zones, other things. I think we are planning to be effective from 1st January 2026.
So we'll hear about that in December then, the zonal tariff.
Yeah,
right?
yeah, we are going to conclude everything.
Final question, sir. Since you've arrived at this tariff without considering GAIL's capex and opex, requirements, could they have any sort of a recourse? I mean,
no recourse. Okay. Just, I would like to clarify here. The last revision, as I have told, was done in from 1st April 2023. Normally, it could have been, the board could have taken a call and continue the tariff of 58 rupees till 2028 only. But we have given the relief of 7 rupees, and further we have given in the clarity in the order that we are going to review from 1st April 2028. Okay. So there is no confusion. I think market should take it as very positive.
Fair point.
We have taken in the interest of consumer also, because these reduced tariff are going to give relief to the in terms of the unified tariff to the consumer also. So we have balanced everything.
No, fair point, sir. I mean, the next relief, like you're saying, would have otherwise been due only in FY28 after the 23 revision. So at least there's some interim relief coming in. We take that point, and earlier when, this was doing the rounds, there was some sense that even a 10% relief, which is now it's 12%, even a 10% relief does add to GAIL's EBITDA and to GAIL's profitability. So we'll see. We'll see how the market reacts. But for now, thank you very much for explaining the stance.
And Mr. Tiwari, I like the way you say the market should take it positively. The market has a mind of its own, sir. They wanted a much higher tariff increase. For the time being, you have stated that this is what you believe you should be giving. And the next 2 years, there will be no relook. But in 2028, they have a date again. And hopefully at that point of time, it increases as much as what the market expects.
Yeah. One thing more, that as a PNGRB and regulator and entire board, we take a considered view in the interest of the consumer and also entity.
Got it, sir.
Absolutely, sir. You have consumers to look after, not just the shareholders of the entities that you regulate. We take that point. Thank you very much for joining us early in the morning and explaining how the tariff hike has been arrived at. Thanks very much. So that's the word coming in from PNGRB, the regulatory board itself. Siddharth Khemka is with us. Siddharth, we have to discuss a lot of stocks, but GAIL first up. Are you convinced 12% is better than 0%, but 12% is not 20%? Your thoughts?
Good morning. I think that debate can continue. Even in our morning meeting, we had a lengthy discussion. So our analyst had not built in any price hikes for this revision. So to that extent, our numbers will get revised upwards by 10%. Definitely, I think the street was factoring in a 15 to 20% hike. So there is a disappointment. But again, I would say it's a 10% hike, which is much better than a 0% hike. Overall, we believe that if you look at GAIL's performance operationally has been pretty steady. Even Q2 numbers, the strong operating, strong marketing gains, the gas transmission volume that has been steady. And we continue to remain positive. Yes, I think today there could be some dip because of the disappointment, but from a long-term perspective, we remain positive given the healthy growth prospects, attractive dividend yield, as well as the supportive valuations.
Okay. Sid, stay on. Like I said, we have lots of other stocks to discuss as well, but we'll quickly get into our first corporate conversation of the morning before we continue with Siddharth Khemka. And our focus is on J&K Bank. Amitav Chatterjee, MD and CEO of the bank, is with us now. And we have lots to discuss, including the bank's fundraising plans. So three key points, just to put it in perspective for our viewers. We want to understand the fundraise, whether this is just an enabling resolution, what are they thinking in terms of the equity part of it. And then, of course, we want to understand the credit growth trends as well. What is the bank's expectation for the second half? And then look at, the outlook on the other metrics like ROA as well. Thank you so much, sir, for joining in. So first things first, you're looking to raise up to 1,250 crore rupees. And I believe 750 crores would be via the equity route. Just run us through the thought process. Is it to boost your capital? Do you have concrete equity plans and a timeline in mind?
Very good morning. Thank you for having me here. Yes, definitely. We had, for the bank, we expect the CRAR overall to be somewhere around 18.5% going forward. Without factoring in the internal accruals, we now believe that this will take us to somewhere around 18%. The very reason why we are trying to raise this capital, fund, is that we have very strong pipeline and a sense of credit growth going forward in the next quarter and a half. So I believe we should be adequately capitalized so that we can go ahead with our growth strategy.
All right. Hi, Mr. Chatterjee. Good morning. Good to see you again. Just a quick question, sir. There's so much of interest in Indian banking system. Are you in touch with any large fund, any big PE? Because the appetite for smaller banks in particular has been very, very large. And we have already seen a few deals that have taken place, both in the banking as well as in the financial system. So is J&K Bank in talks with any particular investor? Or a clutch of investors?
No, at the moment, I cannot say that I am in touch with anybody specific. But to be very honest, I have had very good interest shown by many people. So what you said, the interest in Indian banking and especially small size or mid-sized banks, it's pretty much there. So I believe that the conditions are conducive enough for any capital raising for a bank like us. It's only a matter of time when we feel that we are adequately valued to go to the market that we will start the process. I mean, we have already taken the approval from the board. So we will be going ahead with the process only when we feel exactly the correct time has come.
Give us some clarity, sir. Where is it coming from? From the Middle East? Is it overseas funds that are showing interest? Are they willing to write those big checks? Is the money, coming in from overseas, domestic funds? Give us a sense on that, sir, because you're saying there's a fair bit of interest, even in J&K Bank.
Yes. Overseas interest is there. I mean, I would not deny. But at the moment, since I do not have anything specific to mention, so I would prefer not to go into any kind of details, but the interest is there.
I think the alarm is going off as well. The clock is ticking, sir. We could hear something soon.
Sorry for that.
But sir, you said you'll go to the market when you're ready. Give us some sense, some timelines. Is it going to be the current fiscal year? Could it take longer?
So it could be the final quarter of this financial year, or maybe the next quarter. If you look at our value of the price of the shares, the PB ratio is quite low. It's one of the most undervalued shares at the moment in the banking sector, in all the listed entities. And if you look at the financials, I believe that they are pretty strong. And going forward, in fact, every aspect I see, it's only improving every day. So there is every possibility, and I believe that when we feel that I can actually give a good value to the prospective and the existing investors, it will be the time when we go to the market. The initial thought is maybe to go in the fourth quarter of this financial year, but I am not at the moment absolutely sure that we will do that, to be very honest.
Well, fair enough. You'll do it when you feel you're fully ready and when you will get maximum bang for the buck, as they say, the maximum value creation. Could be fourth quarter, could be first quarter of next year. But let's talk about that value creation, right? And the market values growth more than anything else. So let's talk about that. Your credit growth guidance for the current year is about, I think, 12%. Just tell us what you're seeing around you in the second half, which segments, and I mean, do you think it will be 12%? Is there an outer chance that it will be better than 12%? And what will drive it?
See, I told you last time, the expectation that I had for the end of third quarter, we got it in the second quarter itself. The growth in the sectors within Jammu and Kashmir, especially the agriculture, we had a fantastic growth in agriculture during the first two quarters. The retail growth has been steady. And as far as the corporate loan book is concerned, we have a very strong pipeline at the moment. So the guidance was 12% for the year. We had reached around 9% by the end of second quarter. The reason I said that what I expected in the second quarter, third quarter came in the second quarter is that we had undergone certain process changes where we introduced the end-to-end digital loan journeys for even the corporate loan book. So all these things are in place now. So fortunately, the growth started happening right in the second quarter itself. I had kept some buffer for the processes to be streamlined. So now, since the processes are streamlined and the loan book is, the prospective loan book is very strong, I believe that we can actually exceed the guidance that we had given in the loan book.
All right. So loan growth of more than 12% is possible. NIM's guidance at around 3.7 to 3.8%. That's something that you're heading for, right?
You would have seen the NIMs went slightly down during the second
but for the year, that's the guidance you're putting out, right?
Yes.
Got it. And final question, sir, with regard to your return ratios, the ROE, I think the guidance was reduced a little bit, 15 to 16% from what you started the year at. Confident that you'll achieve this, and I think ROE of around 1.25%. Both those two return ratios in check?
Definitely.
Always a pleasure, sir.
Thank you.
Always a pleasure, sir, talking to you. You're sounding confident. We're going to be waiting by to hear from you with regard to that fundraise, if at all. Wishing you a good day ahead, and we'll chat up soon.
Thank you very much.
Well, time to slip into a short break. Come back. We have our technical experts, Siddharth as well as Mitesh. They're waiting for us. They'll tell us their call on the markets and individual stocks as well.
Welcome back. Well, we are just about 10 minutes away from the pre-open rates. Hormaz is joining in with some interesting data on yesterday's big movers. Hormaz.
Good morning, Surabhi. And Saregama is the first one in the list today. The stock was up over 5% in yesterday's trade. The third straight day of gains for the stock is the biggest single day gain that the stock had seen since February of this year. The volumes on Thursday were the highest since January of this year. So significant volumes as well. Over 90 lakh shares were traded compared to a 20-day average of around 4 lakh shares. And out of those 90 lakh shares, close to 30 lakh shares were marked for delivery compared to a 20-day average of just around 2.5 lakh shares. The stock, well, it's down almost 35% from its 52-week high levels. So seeing some buying interest coming in at lower levels. Ashok Leyland, we spoke about it in closing yesterday. Nigel spoke about it in the FNO bit as well. The third straight day of gains here as well. The stock is at a 52-week high. The volumes were the highest since July of last year, and 9 crore shares were traded on Ashok Leyland yesterday. The 20-day average is 1.5 crore, and out of those 9 crore shares, close to 3 crore were marked for delivery, and a 20-day average was around 70 lakh shares. The delivery volumes yesterday were the highest in the last 4 months for Ashok Leyland, and the stock at around 45% higher this year is set for its best calendar year performance since 2017. Gillette, some buying seen in that stock as well. The stock ended off the lows of the day, of the highs of the day, but still ended around 3.5%, 4% higher. It was only the 18th instance in the last one full year, which is around 250 sessions, that over 1 lakh shares were traded on the stock yesterday, and Thursday's volumes were the highest since May, close to 3.5 lakh shares traded. The 20-day average is only close to 40,000 shares, and out of those 3.5 lakh shares, only 37,000 were marked for delivery. The 20-day average here is only 17,500, and the stock, this one too, is down over 25% from its 52-week high levels. And lastly, a new listing, Prostam Infosystems. The stock, it was the third best day since its listing. It listed only in June of this year, and over 2 crore shares traded. 20 lakh shares were marked for delivery. The turnover was close to 400 crore yesterday, which was well above its free float market cap, which is close to 250 crore. And the stock is up over 70% from its IPO price, which was around 105 rupees. Also remains in focus because a big lock-in ends in the month of December.
Okay. All right. Interesting as always. Hormaz, thanks very much. We'll keep these stocks on our radar as well. Let's go back to Siddharth Khemka for some questions. Sir, I don't know if you could hear our conversation with J&K Bank, but these tier 2, tier 3 banks, they've generated so much interest in the market, right? They're all getting aggressive, raising capital, striking deals. So thoughts on J&K, if you have any. And then there is Bandhan in news today. Bandhan is looking to sell down some of its bad loans. Again, I'm asking because of the huge interest in tier 2 banks.
Yeah, Shurvi, I think I definitely heard the entire conversation with J&K Bank. I think what is happening is, clearly the balance sheet cleanup as well as the growth pickup in the tier 2 or the mid-tier banks, both private as well as PSUs, that is clearly visible. What has also changed is that the regulator is far more comfortable allowing investments, private investments, specifically if you look at some of the foreign investments in these mid-sized banks, and that has kind of picked up the street's interest in some of these names. So by J&K, we don't have an official coverage, but if you look at some of the other names, be it a federal bank, which has done consistently very well, they have also managed to get a 10% stake, strategic stake from Blackstone. That is pretty positive. EU Small Finance Bank, that has been consistently doing very well. Among the few, or I would say the first small finance bank to get a full commercial banking license. Again, I think after the consolidation, the valuations looks attractive. The growth opportunities is pretty strong. PSU banks, mid-sized PSU banks, be it a Canara Bank, be it an Indian bank, be it a Union Bank. I think, again, there is a case for a re-rating along with the fundraise plans that the government allows to do some of them. So, pretty positive on the entire banking space, yeah.
Okay. All right, Sudhar, thanks very much. Shorter conversation today, but thank you for being with us. You have a good Friday, and we'll catch up soon. Right now, a very quick break. Back on the other side, we'll have the pre-opening rates and also get a conversation going on the BFSI space. Bernstein's Pranav Gundapalli will join in. Welcome back. 14 minutes to go before we kickstart today's trading action. And the top story continues to be the tariff hike that has come through for GAIL, Gas Authority of India. In fact, we have Mr. Rakesh Kumar Jain, Director of Finance at GAIL, now joining in, because as we all know by now, and we just heard from Mr. Tiwari of the PNGRB as well, the hike is not at what the company was seeking. It was not as much. Mr. Jain, thanks for joining in. Your first reactions, you were seeking 78 rupees a unit. But what has been agreed is closer to 69.
Good morning, ma'am. Yes, we submitted our tariff for 78 rupees way back in August 24. And if you see in terms of net present value, it should have been around 81, 82 rupees. Yesterday night, PNGRB has issued tariff order, which says tariff approved as 65.69 rupees. However, it's on interim relief basis. Actually, it's not a regular tariff order they are saying. They are saying interim relief, and regular tariff order will be issued in April 28. Actually, tariff orders are normally issued in a block of 5 years, but regulation also says if there are significant change in the principles or parameter based on which the tariff was revised, we can, or PNGRB can ask us to submit, or we can approach PNGRB. So in this case, PNGRB asked us to file the midterm review, and we filed it. Normally, whenever tariff is reviewed, all the parameters based on which tariff is reviewed is allowed, but this time PNGRB has allowed only those two parameters with respect to system use, gas and pipeline capacity, and order says that everything else certainly will be allowed. The order itself is saying, and in April 28.
But you have to wait a little longer. Okay, so let's break this down. That's the thing. They've only taken two parameters into consideration. A lot of the other parameters, including capex and opex, in this order, they've not been taken into consideration. Now, the current tariff is set at 65 rupees 69, 65.69 per MMBTU. At this kind of a tariff, to what extent do you get a help to your EBITDAs? There are some estimates on the street. Brokers are saying it could be boosting your EBITDA by 10-12%. But you tell us.
It will increase by 1,200 crore rupees per annum based on existing volume. And next year, we are also expecting at least 8 to 10% volume hike. So therefore, it will be around 1,300 to 1,350 crore rupees.
Okay, so this year, your EBITDA gets a boost of about 1,200. Next year, the EBITDA boost could be 1,300 to 1,400 rupees. Is that right?
Yes.
Okay. So the question is now, PNGRB told us that you don't have any recourse. I don't know if you can approach any other appellate or anything like that. Or is it that you just wait it out and now wait for the next leg of an increase, which will come in FY28?
Certainly, we will go through the tariff order first because it has been issued last night. In terms of recourse are available. If we feel that there are concerns in the tariff order, so we can approach PNGR if there are some issues in errors, and then recourse are available. But we have not gone through the order, so therefore difficult to comment on this moment. But there is one positive line in the tariff order that it's an interim relief. So we are reviewing it, whether the interim relief is also having some issues or then we need to take up. I only can say the delay in tariff order only impacts customers. As a pipeline entity, we are eligible for 15% pre-tax return because the tariff is calculated on discounted cash flow methodology where net present value will be considered. So any delay in tariff does not hurt us. It can be delayed available, but it will be available at 15% pre-tax return basis.
So the reason I'm asking is that you just told us that if you go by net present value, then with the current operating environment, you would have actually wanted 81 rupees, not even 78 rupees, looking at the current. So there's a lot of gaps. There is a 15 to 16 rupee gap in what you've received and what you think you need. So how will you adjust for this?
No, actually, 8 rupees, and since it was delayed, our submission, if we would have submitted right now 81 rupees. Normally, whenever PNGRB processes the tariff, they moderate certain future capital expenditure and operating expenditure and do up in next revision. So we were expecting the tariff based on those revisions should be 72 rupees, but it has come down to 65 rupees, 69 rupees. There is a gap from our expectations of around 5-6 rupees. And since we are yet to go through the tariff order, we'll see what are those parameters based on which tariff has been moderated, and certainly if we feel that there are issues, we'll certainly take up suitably.
Okay, all right. And that's an important clarification that if you just go by the parameters that PNGRB has used, which are 2 parameters right now, then you think that between your expectations and the current order, the gap is about 5 rupees or so, not as much as 15 rupees.
Just to clear the air, sir, you'll be passing on these higher tariffs to your customers, right?
Actually, we do not have any choice. We do not have any choice in terms of regulation. We have to apply the tariff approved by PNGRB on non-discriminatory basis to every customer.
Okay. Sir, by when do you think you'll go back to the board, if at all, once you go through the order? Should we expect something? Can we connect with you maybe next week?
Yeah.
Because your investors need to know.
Let us go through it.
Yeah.
Hopefully next week we should be able to tell you.
Okay. Okay. All right. Fair enough, sir. So I think we'll give it a couple of days and then GAIL will decide if it is indeed accepting the current order in the current form or whether it needs maybe a round of conversations and negotiations with the board itself. Thank you very much, Mr. Jain, for joining in. That's very helpful. It does clear the air. So there we have it. The whole arithmetic and the math of the order. They had originally asked for 78 rupees per unit. They've got around 65 rupees per unit. They're saying there's a mismatch of about 5 rupees from their expectation. Going by the current parameters that the board has used, the board has only used 2 parameters. It has not considered capex and opex in arriving at this order. It's an interim relief. And I think, the stock right now is reacting down about 6%.
Yeah, I'll be interested to see whether or not there is some buying interest at lower levels, actually, Surbhi, because, some part of the street believed that they hadn't factored in this increase itself.
They were getting nothing.
Yeah, some part of that. So, a large part of them also were factoring in something. So, let's see whether or not that 170 odd level does hold out on GAIL. But let's get back to Siddharth Rai Mangala of Stock Box Technologies, as well as Mitesh Thakkar. Hi, gentlemen. First up, Mitesh, just give us a quick call on GAIL, if at all, on the charts. How's it looking?
Good morning, Nigel. In GAIL, if you look at the last few days, it's been basically in a very tight and a narrow range. And today, I think, with the gap down, it will possibly, break that range on the downside. I think it should head towards 170, 172, which is also most likely very close to the opening price. That is where the stock had bottomed out in September, October. And if it starts trading below that, then I think I'll pencil in another 8 to 9% decline to about levels of 155.
A very crucial support zones. Got that. That's why I said that 170 odd mark was an important mark. But Mitesh, let's get your call first on the Nifty then. Yesterday we went to a fresh all-time highs, but quickly it got rejected. You think we're good for more?
Eventually, we should be Nigel, but the idea is that we cannot ignore the earlier highs as an important pivot. So I think now if somebody wants to take a fresh position, either you wait for a dip or a closing about 26,300. I think in both these cases, it will present you a good entry point. Break about 26,300 will allow you to buy with the 80-90 point kind of a stop loss, while in case that doesn't happen, most likely we'll have a dip to about 25, 800, 850 zones, which is a welcome buying zone.
Okay. Mitesh, also give us your picks then for the day.
I have 2 buys and 2 sells. On the buying side is ICICI Bank with a stop at 1378 for targets of 1420. KPIT Tech is a buy with a stop at 1194 for targets of 1270. A couple of sell calls. HL sell with a stop at 4515 for targets of 4420, and Oil India is a sell with a stop at 423 for targets of 405.
Got it. All right. Thanks, Mitesh, for that. Siddharth, happy Friday to you. Tell us what's the individual calls as well as a quick range on the Nifty.
Hi, Nigel. Good morning and happy Friday to you as well, first of all. See, if we talk about Nifty, Nigel, I actually think that yesterday's move in Nifty was quite impressive, actually, because after the sharp rally in the index on Wednesday, there was some profit booking pressure around the all-time highs, just like you said, but still Nifty very nicely managed to come back above 26,200 towards the second half and close above 26,200, which tells us that the supports now in Nifty are very strong. So the strategy should be very simple in Nifty. From here, as long as the index is above this 26,200, 26,100 range, this is a very strong support zone. Our view should be bullish for the targets trade in the range of 26,500 and 26,600 because the momentum in Nifty should definitely continue to be strong from here. Yeah.
All right. What about stocks?
Yeah, sure. Now, you'll see two stocks. First one is from the FMCG space. I do think that the FMCG space has underperformed for a long time, but there are some early signs of a turnaround, especially in this counter. The stock's name is HUL, Hindustan Unilever. See, the stock was in a consolidation from probably the last 20 sessions, but yesterday we did see it coming out of that consolidation. So HUL can be one of the outperformers. Right now, the spot is around 2450. We can buy it here. The stop loss will be at 2425, and our targets being the first target 2500 and the second target being 2520. The second stock is Glenmark Pharma. See, for the last three sessions, there has been a turnaround in this counter, and I do think that this turnaround is going to continue because now the stock has come above 1900, which was a very important mark for this counter. So now the next targets are straight away in around the 2000 mark. So Glenmark Pharma can also be bought here. Right now, the spot is around 1950-ish. You can buy it here. The stop loss will be at 1920, and the targets being just like I said. The first target is 1995 and the second target 2010.
Okay. All right. Got that. Thanks very much, gentlemen. Let's quickly get to Pranav Gundapalli, Senior Analyst, India Financials at Bernstein. Pranav, apologies for the delay. We just had some breaking news with Gail. But here's the question and why we wanted to talk to you. Second quarter earnings season is over. And in this move to the all-time high, the best performing sector has, of course, been banks and financials. From here on, which are the big bank names that look most promising to you, both in terms of earnings and growth, and perhaps some valuation comfort as well?
Good morning. So I think the overall sector is in a very nice position, right? So you have growth, which is picking up. We saw this quarter that on a sequential basis, the growth rate improve, and then margins are set for an improvement as well. Even if we get a rate cut or two, we should see a steady improvement, or at least no further downside on margins. And we also have asset quality, which does not look like to be a sector-wide issue. So I would say top down, the sector does look interesting. In terms of the names, to us, amongst the private sector banks, HDFC and Axis look extremely interesting. HDFC, given that it will see its profitability trajectory slightly better than peers, thanks to some of its idiosyncratic factors, whereas Axis has the cheap valuation on its side. But the public sector banks also should continue to do well. What we see is that they are able to grow almost on par, if not faster than the private sector peers, while maintaining their 1% ROA, which means across the board, you should see steady compounding for most of the large banks that we see.
That's interesting. Okay, in terms of factors, we'll come to tier 2 banks in just a minute, but just in terms of factors that will be the biggest trigger for stock prices from here, will it be second half growth? Will it be margins not falling, maybe even expanding? What should we watch out in Q3 and Q4?
The growth would be the key. Margins is reasonably priced in that they will start improving from 4Q, if not 3Q itself. And that's not a big surprise. Growth will be key. An improvement to 13-14% growth for the sector would be a big catalyst for the entire sector.
Okay, Pranav, just stay on. We'll quickly get through market opening, and then we'll come back because we need to discuss tier 2 banks as well. I mean, we just had a conversation with J&K, and some of the tier 2 banks are getting very, very aggressive with their capital raising plans. But for the time being, it's looking extremely quiet. I mean, the Nifty just about 20 points. What do you think? Well, bulls charge ahead today, Nigel?
Well, I think the overall structure actually is positive. And I think the near-term support at around the 26,000 odd mark is going to be important. But the broader market, that one needs to participate because for the time being, those portfolios ain't feeling anywhere close to those all-time highs that we have been talking about. The start is more or less flattish. We don't think we have too many stocks that are moving around too much. GAIL, for one, that's a stock that's taking a hard hit, but interesting to see whether or not there is buying at lower levels, because technically that 170-odd mark is important. I think from the broader markets, there are a few stocks that are moving around. Voltam, I think they've got an LOI, so that stock is a little bit higher, and a couple of other names as well. But I think we're counting down a few seconds to go before we get the initial rates that come out, Surabhi. So let's brace for that.
Yeah.
Flattish start with a mild positive bias.
Absolutely. So here we go, and it's going to be about a 20-point up move. Now, can the bulls build on? That's the question. We start a little quiet. Will this be a big day? Or whether we'll see more of the consolidation. Right now, it's about 6-7 points up. Ticking red and green, actually. Bank Nifty is negative. Nifty's flashed a little bit of negative. So the profit taking that we saw yesterday, that continues into the opening moves this morning. Let's see what's down. On the downside, Asian Paints, HDFC Bank, Axis Bank, Kotak Mahindra Bank, actually financials are weak. ICICI Bank is also slightly red this morning. And there's Grasim, there's some profit taking on IT names like Infosys as well. Lever is down. So it's a bit all over the place, you'd have to say. The Nifty is now taken a more decisive move, 30 to 40 points on the lower side. A lot of IT seems to be seeing profit taking. HCL Tech, Tech Mahindra. Banks are a little soft. That's what's going on for the time being. On the upside, Wipro is a bit of an exception with the announcements that they've made, 1% up. M&M is seeing some traction, 0.5% on the upside. And some of the metal stocks, Nigel's favorites, they've had a good week, actually, and some of that continues this morning as well. Hindalco, for instance, is still up about 0.5%. But hard to say. I mean, there's a nice tussle between the bulls and the bears. Right now, the Nifty is flat, just 10 points lower.
Well, that's right. So, a few stocks that are calling for attention. Ashoka, Bilcon, that they have been temporarily suspended from participating in the ongoing and future NHAI bids for 1 month. They've got a show cause notice for construction of the 6-lane elevated corridor in Kerala. So that one's taking a hard hit. That's down in today's trading session. One of the top losers, GAIL. Well, it's trading 5% lower, but it's seeing some kind of support at lower levels. So we'll keep an eye out on that one. The other few stocks that are moving up, Lenskart. There's a Jefferies note that's come in, initiating coverage on Lenskart, and they have a target price of around 500 rupees. They believe the company is well placed. The stock, in fact, is up close to around 2.5%, and it's moving on rather good volumes. Another one that's doing well is Nectar Life. I think they're going to be considering a buyback, so the street likes that. That stock is up and about in today's trading session. Varun Beverages as well is up close to around 2.5% and on decent volumes as well. So that one, in fact, is up and about. MTAR Tech, let's pull up that stock. The promoter entity, Kavita Reddy, sold close to around 2.5 lakh shares. But you had Bajaj Finserv, Motilal Oswal, both of them were good buyers in trade. And Whirlpool, yesterday you saw some large names buying from the promoters. Promoters sold close to around 11.5% stake. And some high pedigree names came in there. HDFC Mutual Fund, Kotak Mutual Fund, ICICI Pru, among others that, did participate in that. So net, it's a flattish start, but broader markets, you have plenty of stocks that are dancing away.
No, absolutely. GAIL is still down about 5%. MCX is seeing some profit taking. Ashok Leyland yesterday, both Tata Motors, CV and Ashok Leyland, the commercial vehicle players, both these stocks were up and about. There's some profit taking this morning on Ashok. Let's pull up Tata Motors CV as well. Yeah, that's also down about 2% as we see. So, Sammy Hotels, you heard the management on the show yesterday, sounding very, very optimistic about their second half plans. Sammy did a nice jig yesterday, it was up 5-6%. There's some profit taking on the stock this morning. Let's see what is managing to buck the trend. Varun Beverages, like Nigel mentioned. VST Tillers and Tractors, there's about a 3% up move over there. So this is what we have, early trends. Hudson Agro, 3% up here as well. The Nifty, by the way, has turned positive. So the bulls are trying to fight back. Tata Motors PV and M&M are interesting stocks to watch. And some of the financials seem to be, turning a corner. Financials, Reliance, and some IT names. So this is looking very interesting. Lever is now positive. Reliance is now positive. SBI is positive. ICICI Bank is positive. So this is an interesting start. Volatile, but we'll see. Bulls versus bears, the fight is well and truly on. Okay, since we're discussing financials, let's quickly round up that conversation with Pranav. Pranav, let's move on now to Tier 2 banks. So much happening, so much deal activity. J&K Bank just told us that they also are, very keen to come to the market for an equity fundraise, maybe by Q4. In the Tier 2 space, what will you watch out for and what do you like?
Yeah, I think in the broader tier two space, we are seeing activity given that it's clearly a benign environment. So if somebody wants to push for growth, this becomes a very nice setup. But most of them are fairly valued at this point. We don't see something that is strikingly cheap. And a big re-rating for some of these will require a strategic shift. Now, large investments would help, but you would need more than investments to pull off some of those strategic shifts. So we'll wait and see if someone can start delivering meaningfully higher ROAs than where they are today. But otherwise, most of these mid-tier banks are relatively well priced. So nothing that screams out as a buy for us.
Okay, all right. Hi, Pranav. Good to see you. And Pranav, for the sector on the whole, credit growth has been lacking. Are you seeing signs that there is some kind of uptake out there? And for the second half of the year, what are you factoring in terms of credit growth for the industry on the whole? And what would that mean for FY26?
Let's see, FY26, we expect about 13% growth. Two, three things will help. One is we have seen some uptick from all the consumption boosting measures of the government, be it the GST cuts and rate cuts and tax cuts. So that has started to show up in the latest quarter numbers. So that's number one. Number two, you also have a favorable base effect because last FY25, the real slowdown happened towards the second half. So the base effect starts to look a lot better. And third, we have some of the regulatory relief as well. So, for example, the bank lending to NBFC is slowly starting to come back. And that, again, had come off last year because of that increase in risk weight, which has now been reversed. So put all of these factors in, we do expect about a 13% growth towards the end of FY26.
Okay. All right, Pranav, we'll leave it on that note for this morning. Thank you so much for joining in. Good to have that conversation, that perspective. You have a great Friday, and we look forward to talking again soon. With that, let's move on and welcome our market master on the show today. Shailesh Raj Bhan, CIO Equity Investments at Nippon India Mutual Fund, is with us. Shailesh, what a pleasure to have you in. We haven't spoken in a while, so good to see you back on the show. And you're coming in at an interesting time where, yes, it's an all-time high, but it's a bit of a hated all-time high, or I call it the all-time high of disbelief. Doesn't feel like an all-time high. People are not dancing. There's no pom-poms out and all that. So what's your sense when you look at the market now? Slow grind, last 12 months, not been easy. What do you think? What's coming up ahead?
Yeah, hi, good morning. See, it's if you look at the internals of the market, right, and you've seen different segments of the market actually have suffered fairly significantly. So YTD, if you look at it, there has been correction in small caps and consolidation in, say, large caps and mid caps broadly. And the differential between small cap indices and the large nifty indices is close to 17-18%. So there has been a substantial under the radar kind of correction happening, especially in the frothier markets of the past, which we had seen last time 12-18 months back. So I think that excesses are being given away as results are in a lot of small cap businesses. The results are not have not been great, and where valuations were expecting a lot more, I think we have seen corrections. However, many good things are happening, right? I mean, from a point of view of earnings getting better. Now it's after 8 quarters, we have heard some reasonable improvement in earnings. And I think early double-digit earnings are clearly possible as we get along from here, which I think is a very good sign. Wherever there are excesses in the market, I think they still have a long way to correct because maybe 20-30% of correction in small caps has happened or some pockets has happened. But wherever there are large excesses, still I think over a period of time, if earnings disappoint there, you will have corrections coming through. So I think it's a mixed market in that sense, but getting better.
Okay, all right. Hi, Shailesh. Good to see you in. It's been a while since we chatted, and you're sounding reasonably optimistic on the markets from here on. In terms of, policy support, we've seen quite a bit, right? Both from the center as well as from the RBI. Anything more you're factoring in terms of, support from the center? Because now it seems that, their headroom is limited out there, going by the kind of freebies that are going to be doled out. The revenue collections haven't been as much as expected, and the capex spend has been higher. So your view with regard to actions from the center as well as from the RBI towards the end of this year?
I think there have been multiple action points which have happened. I think there is very little left to be done. I think it has got to do with the fact that now corporates start investing And general volume growth revive. See, a lot of challenge has been that large volume growth revival has not been there for the last 8 quarters. And when we see that happening or that kind of a revival happening, I think automatically the whole cycle will turn. So the GST cuts have been phenomenal. In my opinion, they will have 3-4 years of 5 years of benefit because it's not going to be just 1 year bump.
Right.
And even income tax cuts actually benefit for 2 to 3 years. So I think a lot of good things have happened and laid into play. I think the only problem was our markets were expensive. The money which had flown was significantly taken higher risk in pockets of the market, and which led to mispricing or excessive pricing, which is actually getting corrected. I think fundamentally a lot of things are in play, especially in the large cap side of the market. And in the small cap and mid cap, earnings will revive over the next few quarters. But more importantly, some valuation challenges still remain there. So you have to be selective there. I mean, that's the way.
Okay, all right. And, the two big beneficiaries with regard to the GST cut have been autos as well as consumption. Your view on both those two sectors?
So auto is clearly the single biggest beneficiary of this GST change, because I think that is visible in the first round itself. And more importantly, I think this will be visible for a 2-3 year period. I don't think these cuts only will help today because they have repriced a lot of things and allowed a lot more consumers to come into the participation space. So I think auto clearly remains a very, very strong opportunity, especially the passenger four-wheeler space, right? Because there has been slow growth for the last several years there. Coming to the consumption side, right? See, consumption side has been suffering more from lower volume growth because of the real slowdown in the urban as well as the rural side of the market for last 8 quarters now. I think there is less optimism there, but I think where there is zero optimism, even if there are small changes in terms of earnings and all, I think there is opportunity for returns to be made. A lot of these companies have derated now for 5 years, 7 years, right? And it's now we have seen some of them now talking about pushing volumes at the cost of margins, driving growth. I think when the direction changes like this, in all probability, next 3 years will be good for consumption.
Got it. Okay. All right. Sailesh, let's talk about, this RBI cuts. And a lot of attention on the NBFCs. The cost of borrowing goes down, and there's hope that credit growth continues to pick up from here on. How are you all placed on that space? Because, we talk about FI selling and not participating too much. There'll be that split argument that they participate in the primary market, maybe they're selling in the secondary market. But the sector that's got a lot of interest and has got an earnings tailwind as well is the banks and financials. How are you all placed there, and what do you like?
Yeah. Clearly, large banks and large NBFCs are still far better priced than most pockets of the market.
Okay.
They have seen their challenges, and a lot of FI selling has also been in these pockets till the last few months, right? And hence the prices and valuations are still sensible compared to most parts of the market. If you look at some large banks haven't delivered even single-digit return in the last 12-18 months. So I think the valuation comfort is significantly there. And the whole upside from a point of view of credit growth coming back and margins stabilizing and improving, I think it's lies still ahead of us. So within the available spaces which are there today, banks and insurance in these spaces are far better priced, especially large banks and large financials seem to be very sensibly priced there.
Okay. The other debatable topic has been on tech.
Yeah.
The bearish argument is no growth, why to give it a multiple? The bullish argument is, if you look at the cash flow yield, it's very good. Maybe the worst is in the price. Underperform, under-owned. Which camp are you in, Sailesh?
So clearly, I think there are, the challenges which are there, right? They are visible to everyone now. I think so. It's a visible challenge, low growth, but I think valuations are far more sensible than they have ever been, I think, in the last 5 years. So I think we are more towards looking at it as at least a market participant. And I think if there are surprises in terms of growth continuing to be maybe early single digit or rising to 7-8% over the next 2 or 3 years, I think you can find reasonable returns to be made. See, growth is a little slow everywhere. I mean, so it's like relative growth is possibly likely to turn here, and expectations are very, very low. Like in consumers, the expectation of recovery is virtually not there. Even in IT service, expectations are running very low. Most people will talk about 5%, 6% kind of growth expectations. But end of the day, in their minds, I think they have believed that IT services cannot grow at all from here. But I think the pricing for that and the valuations for that, most of them would be at 4-5% dividend yield and throwing significant cash and can re-engineer. I mean, it's possible they re-engineer So we are more on the positive side from here on than, possibly last year, because there is enough and more derating in that space.
Okay. All right. Final word before we let you go with regard to returns. Getting into 2026, it's been a challenging year, actually. The Nifty to get away even with a close to double-digit return is very, very heartening. Do you think investors should brace on an average for the next few years of low single-digit returns? Would that be a fair ask? Because I'll tell you what, the period post-COVID spoiled a lot of investors. People got used to saying 20-25% is par for the course. That's not par for the course. Do you think low teens returns from year on is something that we can expect in the coming few years?
Low teens is a best case scenario for returns, I think, is what we see for the next 3 years, unless there is some explosive growth recovery. See, a few things which we are not in full control is what's happening in this global geopolitical side. If things stabilize, their growth recovers for some reason, those could be surprises, but you can't go in with those assumptions being in your favor. So I think earning-led returns is what is possible, and earnings generally can trend between 10 to 13% is what we see. And if you have this kind of a outlook and this kind of multiples as a starting point, I think P multiple re-rating is maybe a very small probability event from here. So I think it's more earning-led, and hence returns would also possibly follow and track earnings. I mean, that is where I think the base case is for us.
Shailesh, the other trend of the year has been the red-hot IPO market and the underperformance of the broader market. I mean, this has largely been a rally about big banks, the larger stocks, right? So two different questions. One is on mid-caps. I'm sure you get asked this all the time, that from here on, now the Nifty is at an all-time high, broader market hasn't performed. So do you expect a better recovery in mid-caps and small caps? That's one part. And secondly, what do you think of the super hot IPO market?
The recovery in earnings has to be there to drive the recovery in small and mid caps, right? So if you look at both small and mid caps separately, mid caps still trade at fairly expensive valuations. So they have not corrected so much. They've actually done well versus what expectations were last year. And these are very high quality businesses between 30,000 crore to 1 lakh crore market caps. And they've done reasonably well, and they've not corrected so much. So there is no easy money lying there. Only earning rate return possibilities exist there. In small caps and more in smaller small caps, the corrections have been sharp. If you look at corrections below 10,000 crore market caps has been very sharp, and generally between 10 to 30 have been okay. So I think there also internal markets are a little too different there. So where there are substantial derating already happening, I think maybe there are some opportunities which are coming about. We have seen some in QSR space, some in some other areas. But in most places, there is still either a valuation correction or large earning positive surprises have to come for us to make good returns out of it. So we think still a SIP-based approach to these categories is still a better way for at least the next 12 months, and then possibly either earning uptick happens sharper than what we are anticipating, which can lead to possibly better returns. On the IPO market, I think it's the most debated. So clearly there's a lot of supply. There's a lot of FOMO, and we've seen a lot of participation by a lot of investors. And we think given just the flurry of IPOs and generally the pricing of IPOs, you would find that because there is very limited time in evaluating these businesses, and these guys don't have a governance track record because they've not been in public markets till now. So at least the public market governance track record is not there. I think this market will have or can potentially have challenges in the next 3 years. So investors looking at this market and investing and choosing have to be extremely, extremely careful in terms of, one, what valuations are paying and what type of managements and businesses are being backed. So I think clearly there is significant supply, and also the fact that the supply is not at very attractive prices. So typically a company without a 5-10 year public track record should actually come at substantial discounts to listed companies. And when we are finding listed companies themselves expensive, then you would expect that the IPO company should trade or come at far lower valuations than that. But because of the demand and because of the significant interest there, we are not finding valuations cheap there at all.
Oh, okay. Well, it is a red-hot market, so I guess the message is tread with caution. Yeah. Take that on board. Shailesh, thank you very much for joining in. Great conversation. We look forward to connecting again soon. You have a good rest of the day. Well, with that, let's move on. We have Nimesh joining in with today's standout brokerage report of the morning. Nimesh, which one have you picked out?
Sorry, sir. Today's standout is on Paytm. In fact, the stock is reacting as well. The biggest F&O gainer. We missed out highlighting in pre-open, but nevertheless, there's a big upgrade coming in from Goldman Sachs and Paytm. So they've upgraded the stock to a buy, and they've raised the target price sharply to 1570 versus their earlier target price of 705. Now they believe that the regulatory environment, which has been the biggest drag on the stock in the past, that is incrementally getting better. In fact, Goldman believes that this is going to translate into an early signs of recovery for Paytm's payments business, as well as the earnings visibility. So Goldman is now saying that the company can sustain 20% plus revenue growth in the foreseeable future. Additionally, there could be more upside to the earnings if there is any positive changes in the intervention of the payments market. Basically, they mean if there is any increase in the MDR, and that would mean there could be further market share gain as well. On back of all this, Goldman Sachs expects that the EBITDA margin can double for Paytm in the next 3 to 4 years, and at this price, the risk reward is quite favorable according to the Goldman. So hence, a big upgrade to a buy now on Paytm, and Goldman has sharply raised the target price now to 1570.
Okay, all right. We'll keep this on the radar. Stock's doing well right now. Thank you for highlighting that, Nimesh. Well, with that, let's move on to another corporate conversation, and we're putting the spotlight on the IT space, and the company on our radar is Happiest Minds. Now, you would have seen that over the past couple of weeks, several brokers, including CLSA and Motilal Oswal, they have upgraded the IT sector, and they're expecting a better performance going ahead. So is there something really shifting on the whole AI front? Is the second half going to be stronger for Indian IT companies? Well, let's put those questions to Venkatraman Narayanan, MD at Happiest Minds. Venkatraman, thank you very much for joining in. And I really want to start right there. We're all trying to understand the implications of this great AI moment for India. And I'll tell you what has shifted. A lot of these brokers whom we spoke with, their argument is that the AI build-out stage is probably peaking now. The billions and billions of dollars of infrastructure that the likes of NVIDIA and the others are putting up. But as we move deeper into the AI adoption stage, that is when Indian service providers will make a comeback. And the use of AI in the delivery of services, that's where the numbers and the growth and the deals will start coming back on stream. Now, you tell us, you're a participant, so I'm sure you'll have, to that extent, you'll have a slightly biased view. We all want to believe this. But can this really happen? What are we in for as we're looking at AI and Indian IT in 2026?
I think you got it absolutely right. Just like any capex cycle, you have a capex build out, and then the revenue cycle starts after that. If you look at the AI boom or what's been happening across the world, it's been billions and billions of dollars being poured into the infrastructure part. But for anything in the tech or technology space to really take off, you need to create ecosystem. You need to take up. There has to be adoption. And both of these happen only through, what you call a social media effect, or what you talk about adoption by people who want to use it for furthering their business. So until now, what's happened, the infrastructure build out is happening. You have got the large tech companies pouring billions into it. Now, to make sense of this for the enterprises or for application service providers, you need the services to be built around it. And then you have service partners like us help that build out. And this has been how it has been, let's say, many years back when the ERP boom happened, where the software services, people coming out with big bang approach on the ERP, but you then need the consultants to do the re-engineering, remapping, and implementation. And that's where the consulting services companies and the tech services companies really came into to the fold.
But Venkatraman, if you could dive a little deeper, what makes you confident then that Indian IT service providers will be able to capitalize on this opportunity the most? I mean, there will be competition from the likes of an Accenture and the other big, consultants as well. So, and till now, we don't have very definitive numbers for the industry as a whole, even for individual Indian companies, that, what will the AI part of the revenue be? So for the street, it's also a little hard to map this. If you could give us some more light.
Yeah, I think we have been one of the very few companies that have set out ourselves the goal of, setting out the numbers that we get from AI. We started out by making it a segment for ourselves. Yeah. So right now, 2.7% of our revenues comes from AI. The difficult thing out here is almost all the work that we do today is AI-led. how do we differentiate between what is core AI versus what is AI-led? But that's a challenge that we'll come up to later. But as of now, the way we are identifying core AI business is about 2.7% of our total revenues. And we are looking at that growing to about $7 to $8 million by the year and grow to 5% very quickly. And we have also put out the points that we have got 22 use cases right now, replicable sales or replicable use cases, which help enterprises adopt and make the most out of the AI infrastructure that's being built out. So that's something that we have set out, and we have also said that the revenue potential for somebody like us is about $30 to $50 million from there. We have signed up 30 new customers, and almost all the customer signups, I would say 28 or 29 out of the new customer signups that we have been AI-led. So you're seeing how we are becoming, the approach of being an AI-first, AI-led company is helping us. And all of this on the services front. Let me say that as well. Because, we are not doing anything on the infra side or setting up infrastructure side. Yesterday, for example, we have launched our own agentic AI support AI platform called Elera. We have released a press release on that. Shows that we are getting ready to even tackle the L1, L2 part of services side from with agentic AI support. So this is where we are coming from. And the Indian IT services company, when we say we have done 22, I'm sure the other companies are also building out similar use cases. And they are also
this, Venkat, this $30 million of, an expected pipeline, AI pipeline, this is over how many quarters, by when?
No, we have said over the next couple of years. That's what we have said. Because you have 22 use cases. We have started seeing traction with our existing customers, and then you do an arithmetic of how you will sell this into existing and the new customers in the prospect database, and have come to a number that's how we have come up with this $30 to $50 million.
All right.
Just like the 30 signups will likely lead up to $50 million is what we have said. Because what's the kind of run rates that we have today? You have the run rate multiplier, and then that comes to about $30 to $50 million. You have to build it piece by piece.
All right. Hi, Mr. Narayan. Good to see you, Ben, sir. Give us a few more details. Sneak peek into Q3. How have deal wins been? How have logos been? And if you could give us a sense on furloughs for Q3, a broad sense.
We have not seen that high numbers in terms of furloughs as of now, or at least we have not got any indications of that. Because in our business, as we have said in the past, we do have furloughs with a couple of clients, but it's not something that's uniform. Yes, Q3 for the industry typically is slightly on the weaker side, but we have been confident. We have said that we'll do our double-digit growth for the year. We have done 11.8% half year over half year in dollar terms, and about 2.3 QOQ and 6.7 half year over half year. So what we are saying is we'll see a similar kind of growth continuing in Q3. We will have some small impacts of furloughs, but then we missed out some growth in Q2 thanks to pushing out of the product, the Artha banking product revenues going into the next quarter. So that should help us set off. That's how the numbers stack up for us in Q3.
Okay, and you're rather confident, right? Next few years, double-digit revenue growth is there for the taking.
That's right. That's right.
And all
in fact, I had the opportunity of hearing the gentleman just before me from Nippon. He was talking about how the expectation is very muted from the tech sector. So I would say, compared to that, happy to say that we are still keeping our numbers high at about double-digit growth, and hopeful that we'll continue to perform on that basis while capitalizing a lot on the AI flood that's happening currently.
Any inorganic growth is what you're looking at?
Yeah, that's something that's consistently on our radar. When we have something more solid, absolutely, you'll be the first to hear from us.
Venkatraman, what will this AI, expansion, what will it mean for margins? In the past, you've said that you'll probably be maintaining margins at the current level of around 20%. But what's going into those conversations on pricing, on upskilling the workforce? Tell us more.
Yeah, so on the margins front, I think it's only going to improve because the AI business of ours has started breaking even. I would think at least 6 months ahead of what I thought it would. Happy to say that from Q1, Q2, we have started breaking even. And it's starting to pull in margins into the company. So that's something that's been helpful. The new sales engine, which is where we were pouring money in or investing, that's also beginning to show results. Like I said, we have got 30 new logos, and it's that with potential of $50 million over the next couple of years. So investments that you make are beginning to show results and help margins. On the pricing side, yes, AI, the pricing for AI capabilities or AI services is slightly a notch higher than what we do in the digital side. So that's something that's helping us. But yes, continued investments into new technologies, retraining people, making sure that utilization continues to be high. Because that's a challenge. You have to retrain, repurpose, get people adapting and adopting the new technology. So for that, we will be making investments. Also, the compensation levels could be slightly higher. So that those things will continue. It's something that we have to do.
So to go back to the timeline that you shared, by the time that you are pulling in $50 million from AI, and you said that's over the next couple of years. I mean, what is the margin trajectory? Will it be slightly higher? But then you were saying that obviously you have to pay more to these.
It should be higher. It should be higher. Today we are at an operating margin of about 17.2%. And this is, I don't want to use the way slide down, but it has come down from the 18.5, 19% in the earlier part of, let's say, early part of last year, primarily because of the investments that we made. So these investments, when they start paying off, you have to start gravitating towards the 18% operating margin. So the thought is always to grow with margins, protecting margins and growing margins.
Final question, sir, before we let you go. What about your investors? They have been hanging in there. Those that got in the IPO will still be happy. But some who have bought in the last few years, they'll be wondering what's happening to the stock price. Management sounding optimistic. Yes, the sector has gone in a bit of a tizzy, but the stock price has come down dramatically. If you had to give them a message, what would it be?
Stay strong. Again, I'll go back to the conversation the gentleman was talking about before me from Nippon Mutual Fund. He was saying that, an IPO is only start of the journey. We are 5 years into the journey, and we have not, cost despair to our investors, at least from the performance, the company's fundamental performance. Pricing is something, which is relative, which has got quite a bit of sentiment attached to it. Many of them beyond our control sometimes, and that's what seems to have happened. But as an industry, we stand tall, we stand strong, and I think the AI, there was a little bit of angst with AI, but I think the industry will continue to grow, will continue to take up every opportunity to go deeper, work for our customers, and make sure that we really pay back our shareholders and stakeholders.
Well, I think those shareholders are happy listening to you right now, Venkatraman. Stocks up 6-7 rupees over the course of this conversation. So we wish you, your teams, all the very best as you move forward. But there you go. I mean, you have an industry player basically verifying what some of the analysts have been saying, and that's the point that we've been making, highlighting some of the brokers like CLSA, like Motilal, all of them saying that you have to move past the build-out stage. That's where India wasn't present. We don't have billions of dollars pouring into AI build-outs, the chips and the data centers, etc. But when it comes to using AI to deliver services, that's when the Indian companies will make a big comeback, something that Mr. Venkatraman has also agreed with. With that, let's take a very quick break, but we'll come back on the other side. The corporate conversations continue, and we'll be in touch with the management of IGI, International Gemological Institute, and we'll figure out how the second half trends are looking like for the diamond certification business.
Welcome back. Well, just a quick check on some of those metal-related stocks. As our ticker team was telling us, silver prices are moving to fresh all-time highs, and that's why Hindustan Zinc is seeing very, very high volumes for the first 30 minutes odd, because that's the only play on, on silver. So that's up close to around 1.5%. Very, very volatile moves is what we see on Hindustan Zinc, so keep that in mind. And IMFA is the other stock actually that's higher because ferrochrome capacity is globally, there's been a bit of a shutdown owing to the high cost of production. The recent shutdown overnight is the Samankor chrome, smelter that we saw. So the overall cost of production is going up. That's resulting in higher ferrochrome prices. And in turn, IMFA is gaining because they're backward integrated. So explains why a stock like IMFA is up close to around 5% or thereabouts. That said, let's move on to IGI. We have Ishwar Iyer, the CFO, who joins us on the show. Hi, sir. Good morning. Good to see you in, Mr. Iyer. Tell us, how are you seeing business prospects shape up? And, what's the outlook like towards the end of this year and for the next year as well? If you could quantify the kind of growth and profitability you're looking at.
Well, good morning, Nigel, and thanks for having us back on the call. Yeah, it's been some time since we last met. I think the Q3 performance was in sync with whatever we have actually been speaking over the last 2 quarters prior to that. We grew around 26% on volumes and around 20% from a revenue standpoint for Q3. So YTD, in line with what we had given as the guidance at the beginning of the year in terms of 15% revenue growth and 20% EBITDA growth, YTD we are at around 16% of certification revenue growth, and EBITDA growth is around 22%. So I think we've been on, in terms of whatever guidance we had given at the beginning of the year, we seem to be, being able to deliver that during the course of the first 3 quarters.
Okay.
I think the business continues to be robust. Obviously, we're expecting some headwinds because of the tariff, etc. But that haven't played out, at least in Q3. So we continue to remain very optimistic about the business performance for the Q4 and again for the next year.
All right. So you're saying, 15 to 20% revenue growth is something that you should be growing from year on, and margins holding in the mid-60s. Is that correct?
That's right.
Tell us about growth, vertical-wise. How do you see the revenue mix shape up? Because last quarter we saw the natural diamonds out there, that segment growth was even higher than lab growns. Is this, a bit of a turn, a bit of a pivot that's taking place? Do you expect more of the same?
Yeah, I think, Nigel, I think while the lab-grown segment has enabled us to propel our volumes over the last 3-4 years, I think our focus remains on certifying diamonds. So we have separate verticals to manage natural diamond, the business, a separate vertical to manage the lab-grown diamond business. So each of the functions are delivering in terms of, what is the expectation as far as either gaining market share or holding fort where we have high share. So I think all the levers have worked in Q3, and also it coincided to be the Diwali quarter, right? So we have obviously natural diamond and natural diamond jewelry also shaping up pretty well. So yes, natural diamond had an exceptional quarter. We grew some 29% in this quarter, and YTD again we are at around 14%. So I guess this is a combination of being extremely focused on the key revenue segments for us, which is both natural diamond as well as lab-grown diamond sector. So from that context, I think we've seen some extremely strong performance across all the 4 segments during this quarter.
So, Ishwar, however, this trend that we've seen with the natural diamonds doing better for you this quarter, was this just a festive season phenomena, you think? Or is there something more to it? Is there something more changing?
See, I think we're making significant investments as far as building capability around this vertical as well, because the natural diamond segment is an important segment for us. So, from that context, we continue to be extremely focused on this segment as well. So what we are seeing, I think YTD we are at 14%, and I think it's in line with whatever we've been expecting from this vertical in terms of 14-15% year-on-year growth. So from that context, nothing out of line. I think it's in line with what we've set ourselves internally as the target that we have to focus on for the natural diamond segment during this year.
So your average realized price, looking at the data that I have before me, that showed a year-on-year decline to about 854, if I'm looking at the right numbers. I'm guessing this is the average price of certification, right? Can you walk us through what's going into the mix now? Because you're doing, across segments, lab-grown diamond, natural diamond, lab-grown jewelry, diamond jewelry. So how is the pricing shifting for each of these segments?
See, in line with what we've spoken in the past, I think over the last 14, 15 months, we've seen extreme stability as far as the lab-grown pricing is concerned. Obviously, natural diamond or the jewelry segment, those pricing have been pretty stable over the last 2-3 years. But yeah, importantly, the lab-grown businesses remain stable since the pricing correction that we took up last May, which is April, May of 2024. So from that context, pricing has remained stable. Obviously, a slight up and down on the average realization in each quarter is consequent to the mix shift that happens between segments. So from that standpoint, I think we've been extremely stable. Nothing structurally that has changed over the last 3 quarters.
But certification of lab-grown diamond jewelry, again, I'm sure it's a growing business, will be a high-volume business for obvious reasons. But in terms of just the pricing, I don't think this would be too margin accretive at this point, would it?
See, for us, both be it natural diamond or lab-grown jewelry, I think the pricing has been around $3 to $5 per report. I think we are expecting that volume to really help us build up the revenues and the margins. We are not looking at it solely from an average sales price realization standpoint. I think it's an emerging segment for us. We expect the India market, the India consumers to come into the fray. So this this vertical is just starting to build some scale. So I think the focus will be for us from a volume standpoint. We're not too perturbed about what the average realization is going to be as far as lab-grown jewelry is concerned. It's an emerging market. I think we have to participate in it in its fullest form. And with the way the gold prices have behaved, the silver prices have behaved over the last 3-4 months, I think it's an emerging market which has the potential to really leapfrog other segments, because with the combination of lab-grown diamonds and the high pricing for gold and jewelry, we expect this vertical to really dramatically scale up over the next 2-3 years.
And lab-grown, I think, is around $15 per certificate, right?
That's
roughly.
Right. Yeah.
And natural is approximately double of that, if I got that
around
right.
3 times, yeah, around $40-$45.
40 or close to 2.5 to 3 times at least. Got it. Final question: what about market share?
Okay, again, I think the growth that you're seeing in natural diamond, I think that is consequent to some market share gains that we are seeing in India. Lab-grown will continue to do pretty well. I think we are a significant player in the India market as well as in the global market. So I think market shares continue to remain stable for other segments, and we are actually seeing some market share gains in natural diamond, which is what is propelling the growth in that segment.
Okay. All right, Ishwar, we'll leave it on that note. Thank you very much for joining in and giving us some perspective on the business. That's IGI as the trends shape up for the second half of the year. Let's look at how trends are shaping up in the market. The good news is that some of the big boys are fighting and fighting really well. Reliance is up a whole 1%. There's a broken note. I think it's a Jefferies note, if I'm not mistaken. It's quite optimistic on Reliance, and we'll get to that in just a bit. And then you have Lever pitching in, L&T pitching in, SBI pitching in. Some of the big boys, they have started contributing on the upside. Nagraj Shetty is with us, so let's ask him what the trading approach should be for today. Nagraj, good morning. So once again, getting close to yesterday's highs. We're 50 points away from that. What's your plan for today?
Good morning, Surabhi. Yes, certainly market is in a strong uptrend. Current consolidation after a sharp up move is indicating the uptrend continuation pattern. I'm not expecting any bigger hindrance from here on out, so though there is a slight resistance around 26,300 odd levels. For me, the upside target would come around 26,600 or something, where the Fibonacci extension would cluster in at the higher levels. That is going to be the target for the Nifty in the near term. And on any dips, on any consolidation, 26,000 to be watched as a support level for the market to bounce back.
Okay. All right. Hi, Nagraj. What about individual stock calls?
Hi, Nigel. I have 2 stocks, one from IT side, one from chemical side. IT side, LTI Mindtree, chartically has been in a good uptrend. High tops and bottoms on the chart is indicating a positive bias, and currently trading around somewhere around 6,050 levels. I'm expecting this to move up further from here onwards. One can look to buy around this level 6050, and the immediate upside target would be around the 6350 levels. One can place a stop loss at 5850. Second one is from SRF. SRF, after a decline, seems to have formed an important bottom reversal just below the 200-day EMA, I think looks like the worst seems to be over for SRF. Currently trading around 2922 levels. One can look to buy at current market price, and the upside target would be around 3,150 for the stocks, and one can place a stop loss at 2825.
Okay, all right, Nagaraj, we'll leave it there. Thank you very much for joining in. Let's take a quick break. Coming back on the other side, all the commodity cues with Manisha Gupta. So, both the notes that have come out from Jefferies are seeing stock reactions today. Lenskart is one. Lenskart is at 414. Jefferies thinks the stock can go to 500. They are identifying some levers there. And the other one is Reliance. I'm just checking the price target on Reliance, 1785. That's what Jefferies thinks Reliance can do. It's basically highlighting, the brokerage is highlighting that all of Reliance's businesses are firing and are all set to deliver double-digit growth this year. And they think that with the Jio IPO happening, perhaps there will be another round of tariff hikes. So those are some of the triggers because of which Jefferies feels that Reliance is all set for higher levels. And it's definitely helping the market's case as well today, taking things up and higher. We'll have Manisha join in the next couple of minutes. By the way, look at GAIL. GAIL has still not recovered. Despite all the assurances from the PNG-RB that this is only an interim relief and more will happen in FY28, the fact is it's been disappointing for the market. The market expected 20%. The company was seeking a 33% hike. What has been delivered is 12%. And that disappointment still visible on GAIL. But Nigel, the rest of the market has moved on. 50 points up on the Nifty now. So it's perked up.
Well, that's right. And the stock that we just highlighted, Hindustan Zinc, the only way to play silver, because I think close to 45-50% of the EBIT comes in from the silver business. That's moved to the high point of the day as we speak. Volumes fairly high as well. But on that note, let's hop across to Manisha. She's here to tell us what's going on in the commodities market. Manisha, take it away.
Well, taking cue from what you were just talking, Nigel, I'm talking about silver, by the way, because we're just $0.50 away from all-time highs yet again. So 54.5 is an all-time high, and we seem to be trading around that $54 ounce mark right now. For the year, prices have gained up by 87%. And the silver rally started from mid-October in 2023. So when you look at the prices from there on, it has gained 165%. That's the kind of return that silver has given you in last 2 years itself. In the month of October, 2023, silver was trading at around $18 to $20 an ounce, and it's trading at 54 right now. All-time high has been 54.5. We started this year with 29.5, and it constantly has been gaining since then. We did 45.5 by the month of September, and from there till time, it has been $10 an ounce of a jump up coming in. Silver has seen some profit taking since the time we saw all-time highs there. It did go down to 47 as well, but the rebound that we have seen in the month of November clearly has been quite strong, giving us nearly 15% of gains for the month of November itself. Well, 85% probability of a Fed rate cut in the month of December is something that has been supportive. And then the street is counting in that you might perhaps be looking at 3 more Fed rate cuts by the end of 2026. And that is the whole of next year is also supportive for prices. Take a look at the kind of silver demand that we are looking at. Well, the industrial demand, we did see an all-time high of around 689 million ounces last year. And the expectation is that you could be looking at that number or slightly higher, up to 700 million ounces of a record number in sense of industrial demand for this year as well. Within the industrial demand, it is the solar panels which really are giving us a very, very strong numbers coming in there. And that is what you should be looking at, because 2020, the solar panel demand was at around 94 million ounces. Last year was 243 million ounces, with an anticipation that way the industries are going towards solar panels, not just India, but various other global markets as well. You could be looking at some more support continuing there. Take a look at the silver market deficit as well, and that has continued to be on the stronger side as well. This is going to be a 5th straight year that you're looking at a deficit in silver space, and that has been supportive. And then, of course, we are looking at strong physical, ETF, institutional buying. All of that has been very, very supportive. A lot of people bought physical silver in India, and that has led to a lot of premium coming in for the markets as well. Well, where is silver headed going forward from here? Macquarie, for one, is the most bearish of the lot. They expect that silver could be looking at an average of $35 an ounce of a price in this year. Everybody else is into 40s and then in 50s as well. World Bank, Citi, Deutsche Bank believe that $41 to $45 of an average price is what you could be looking at in case of silver. target prices for silver on the higher side could be as high as 65. There have been targets of 70, 75 as well. But most bullish clearly seem to be Bank of America and Goldman Sachs. We're giving up $65 an ounce of higher side targets. So while we are very, very close to all-time highs for silver right now, the expectation is that you could be looking at this outperformance continuing in next year, and much higher highs is what you could perhaps look at.
Okay, all right. Thanks a lot for that, Manisha. By the way, some comments coming in from the HAL chief clarifying that there's absolutely no problem in Tejas and saying that that export potential does continue. Some initial comments that are coming in there. Keep an eye out on the bottom of the screen. Post those comments. We are seeing that the stock has perked up a little bit on the screen. But talking about stocks that are perking up today, Lenskart. Jefferies has taken a closer look. The lens is on Lenskart. They believe that the stock could head higher from here. Vinny joins us to give us details on that particular report. Vinny?
Hi, good morning. So Jefferies has initiated coverage on Lenskart, buy rating, target price of 500 rupees per share. And do not forget, it is India's largest tech-driven eyewear retail holder with 5% market share. Now, what will do well? One, they believe that offers are quite strong in terms of the growth potential that is there, that comes in from Lenskart's point of view. Other than that, they believe verticals, they're quite integrated, omni-channel model that is working out. So cost efficiencies there, rapid deliveries there, superior customer experiences there. And India serves as a bedrock with more than 85% contribution to EBITDA coming in there. Also, they are seeing that there is good unit economics, which are quite attractive. Fast payback is there, and that should be something that will drive a 50+% adjusted EBITDA CAGR growth. So they're quite positive on the growth for the company in the next 3 years as well. And do not forget, the company will be reporting their numbers tomorrow, so we'll keep an eye out on that as well.
Okay. All right, Vinny, thank you very much for that. We'll take a quick break on that note. We'll come back on the other side and get you excerpts from our exclusive conversation that we had with Jonathan Garner of Morgan Stanley.